You know, I was thinking of getting my teeth whitened, but decided to get a tan instead. So prepare for trouble and make it double. To protect the world from devastation, to unite all people within inflation, to denounce the evils of truth and love, to extend our reach to the star. All right, I'll stop now. But I was thinking the other day, it's kind of crazy how many inflation-based words there are in the economy. It's hard to keep track of all of it. There's inflation, deflation, hyperinflation, stagflation, disinflation, and there's different types of inflation within some of those, like demand pull inflation, which is on the consumer side where we want to buy more stuff, so the supply goes down and the cost of stuff has to go up. Then there's cost push inflation, which is where companies respond to wage growth by increasing their prices. Then there's built-in inflation, and it's like, Jesus Christ, can we get a break from the economy for a second? Economy's like, I got you, fam. I break for you. No, but seriously, I'm not an economist and I'm not an expert, so the word disinflation is pretty new to me, and Jerome Powell, Papa Powell as I like to affectionately call him, the bankers and economists have been using that word a lot. And if you're someone who likes to buy stocks and invest in the real estate market and buy crypto, and you're employed and you have a job, I want to explain exactly what all of this means and how this will affect us. So let's pause Hogwarts Legacy for just a second. At any time, feel free to slither in my like button. I don't know what that means, but let me show you the latest economic data and how this will affect your wallet, and then I want to give you a separate update on a crypto app called Voyager. So with that said, let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well, and I just got back from Hawaii. I took my parents on a vacation with me, and this was the first vacation where I had 2 weeks off in 5 years. It's pretty crazy, but sometimes it's nice to be reminded that there's more to life than just working and making money. But speaking of money and smooth transitions, there's good news and bad news for the economy. The good news is that the unemployment rate hit 3.4%. The last time it was this low was in the year 1969, which also happens to be the year that Neil Armstrong became the first person to walk on the moon. It was also the year that there were 203 million Americans versus 333 million that we have today. But one thing that stayed the same throughout all of it is the Federal Reserve and their goal to keep inflation growing at 2% per year. Now, this just means that economists want the price of everything on average to go up 2% per year. And the reason they went with 2% is because they believe it is low enough for people to not really notice the price of everything growing, so they wouldn't have to budget around everything, but it's also high enough, which gives them a little bit of headroom to have influence over what's called monetary policy. And they can influence it in a couple of different ways, including lowering interest rates to stimulate the economy to grow by making it cheaper to borrow money, or by increasing interest rates to slow the economy down by making it more expensive to borrow money. And their entire goal is to do all this without affecting jobs and employment. Now, in 1969, the interest rate hit a peak of 9.15%, but fast forward to today, and our interest rate with the federal funds rate is about half of that. Now, everyone wanted to believe, investors and retail traders, that the Federal Reserve was going to pivot and start lowering their interest rates this year. But the truth is, the Federal Reserve is a bear and it don't care for people making money through investing, and the rates are likely going to go up. And that's thanks to a new word in my vocabulary called disinflation. Disinflation is really easy to understand. All it means is that the rate of inflation is starting to slow down. So that means the price of stuff is still going up, but slower than it used to. So disinflation is good, but disinflation also has elements of inflation, which is bad. So here's what it means. In the last CPI, or Consumer Price Index report, the inflation reading was 6.4%. That means from January 2022 to January 2023, the price of stuff went up 6.4%, which is lower than the all-time highs, but it's still too high. Now, if you're someone who likes to compare the cost of stuff month to month instead of year to year like a normal human instead of an economist, two very different species, then that has actually gone up by 0.5%, mostly thanks to higher gas prices. And even though the cost of used cars is finally starting to come down, the cost of everything else is going up, including insurance, maintenance, medicine, electricity, and most importantly, rent, which is still up a huge 8.6% year over year. And corn inflation. Core inflation, not corn inflation. We're not inflating corn here, but core inflation, which takes out food and gas prices, and it's supposed to be a more accurate way of measuring inflation, is still up 0.4% month over month, which proves that even with the mental gymnastics that economists like to use sometimes, inflation's really sticky, and once prices go up, it's very hard for them to come back down. And this is exactly where Papa Powell comes in. He's like a wizard, probably a Hufflepuff. I think he tells the truth, and I like him, but he has two main spells up his sleeve. sleeve. And spell number 1 is that he makes you believe that interest rates are going to go up and they're going to stay there for a very long time. It's more of an illusion charm. And then spell number 2 is to actually increase the interest rates. Now, according to the CME Fed Watch tool, which so far has been incredibly reliable at predicting future rate increases, right now it shows there's an 87.8% chance that the next rate hike, which will happen on March 22nd, that it will go up between 0.25 and 0.5%. So the new range will fall between 4.75 and 5%. So that's the boring data stuff with interest rates and employment. Now let me just tie it all together and show you what's happening to the market for buyers and investors. So here's what's crazy. The S&P 500 index, which is what everyone refers to as the stock market, is up 9% year to date, which is insane because we're just 2.5 months into the year, and that's a year's worth of gains baked into the market. But what's really gonna blow your mind is that it's the riskier stocks that are doing the best. Goldman Sachs, for example, has 2 really interesting indexes that it tracks, and one of them is the non-profitable tech basket. Now, this is a bundle of stocks that are tech stocks that haven't yet made a profit. So these are obviously more risky and much more speculative. The second interesting index is called the Most Shorted Rolling Index, and it is a bundle of stocks that people essentially bet against. So it's probably a Wall Street Bet's favorite. But both of these speculative indexes are up over 20% year to date and way outperforming the S&P 500. Also, whether you like it or not, Bitcoin is up almost 50% year to date. And crazier still is that it's the value stocks, like dividend stocks, that are not doing as well by comparison. VYM, for example, which is Vanguard's bundle of high dividend yielding stocks, is up only 2.3% year to date. The market's like, are you not entertained? Now, in a normal recession, if there ever is such a thing, investors want to park their money where they feel it's the safest. And that should be value and dividend stocks because they have cash flow and a provable business model. They've been around forever. So what's going on? It makes perfect sense if you think about it, because dividend stocks are not paying very much right now. And because they're not, you're still risking money with dividend stocks, so you would rather put your money somewhere with treasury bonds where you can get a guaranteed 4.5% without ever risking your money. But that still doesn't explain why it's the riskier tech stuff that's not profitable that's doing even better. And the reason why it's doing better is because the market right now believes that inflation is going to go away very soon and that the Fed is bluffing about increasing those interest rates too high for too long. And that's the only reason why this is happening. The market has priced in that assumption. Now, I have no idea whether or not that's going to happen. So for now, I'm still continuing to invest the same way by dollar cost averaging into VTI and reinvesting all of my dividend income back into itself. But if you're someone who's a saver, or if you want to look into real estate, then here's what's going on. The good news is that the yearly APY on savings accounts is going up, which is nice. But if you're looking into real estate and you want to buy a house, remember that the federal funds rate, which right now is between 4.25 and 4.5%, is not the rate we get to borrow money at. That'd be really nice, but instead it's the federal funds rate plus prime rate, which is about 2%, plus whatever our credit score happens to be. Now, if you want to be even more accurate for extra credit, instead look at what the yield is on the 10-year treasury bond. That is what the 30-year mortgage usually tracks. So I know that sounds really confusing and it sounds like I just spoke a different language, but if you want to check this for yourself, all you have to do is go to Google and type up the 10-year treasury bond, and it will show you the yield or the interest rate that it pays, which right now is about 3.8%. Now, if you add 3% on top of the yield of the 10-year treasury bond, you get what the mortgage rates would be for the most qualified buyers, which is about 6.8%. And it just so happens the math works out because according to data from bankrate.com, that's exactly what we're seeing. As of this week, on February 15th, the average 30-year mortgage rate was 6.7%. Now, pop quiz, when the federal funds rate go up, what happens to mortgage rates? Time's up, you are the weakest link, goodbye. No, you probably thought that it also goes up, but that's not what ends up happening. This is so crazy. It's one of the things that I always forget about, but this is how it works. Always remember that the market is forward-looking, meaning stocks, bonds, and the interest rate on loans, which is based on those treasury bond yields, is forward-looking, meaning that the money that lenders are giving us today, those interest rates are based not on the current rate, but based on the future assumptions of what those rates will be. And I already told you what the future assumption of the market is. Remember, the market already expects a 0.25 to 0.5% increase. So the loans they're giving out today are already based on that future rate. So come March 22nd, when they do raise the rates, if the rate goes up again for that 30-year mortgage, it will not be because of that rate increase, but based on the market's future new predictions and assumptions. Why this is useful is because hopefully it will help you to not compulsively invest or buy a stock that you found out something secretive about. In fact, every rumor, every bit of information has already been taken into consideration, and that stock's price or Bitcoin's price or whatever thing you're doing has already been reflected into it. So just remember that the next time you get some hot stock tip. Now, I also promised you a crypto update, so here it goes. Voyager, the crypto brokerage app, is in the process of being purchased by Binance, which means we could see a portion of our holdings returned to us as early as March, but it also depends on having a Binance account. So here's what I did. I opened up the Voyager app and I clicked the claims tab, and here you'll be able to opt in. Now, at this point in time, you don't have to do anything. You just have to wait for an email from Binance.us to make an account once the money is ready to be distributed. Now, the amount of money that will be given to us will be based on what our account value was on July 5th, 2022. Not the whole thing, just a portion of it. I've seen estimates from 20% to 51% and even higher. No one really knows, so I guess we'll have to wait to see until the announcement, but I wouldn't hold my breath and I would be shocked if it was anything as high as 50% after legal fees and expenses. In my completely unprofessional and unqualified opinion, I wouldn't hold my breath. But having said that, if you follow me on Instagram, I'll give you an update as soon as I find out. And in the meantime, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes Wednesday. See you soon, bye-bye.